Thank you so much for taking time out and speaking with us. It's been a very exhaustive report, and you've touched on practically all the important factors when it comes to really deciding what the trend will be for private equity and overall deals going forward. I want to pick your brains on specific areas, starting with investments. Do you expect the pace to continue in 2019? Of course, if the first quarter is anything to go by, it seems to be a bumper year ahead as well, because $10 billion is what we saw in the first 3 months of 2019 as well. So how do you read this investment trajectory going forward?
So we actually expect the investment trajectory to be fairly strong. As you mentioned, I think we tracked somewhere around $9 to $10 billion of capital that went in quarter one. The last 2 years saw about $26 to $27 billion. So last year we had it closing at about $26.3 billion. And so Q1 saw $10 billion. I think Q2 might be a little bit slower, primarily driven by election and a bit of wait and watch from an investment perspective. But investments are driven more by fundamentals, sector fundamentals, growth, etc. And if you look at the sectors that have driven investment, 40% of investment in the last year, at least in 2018, was driven by consumer internet and banking. These are two sectors that we expect continued strong growth. So going forward, we expect 2019 to be another bumper year. I don't know about the exact number it'll end up at, but fundamentally we expect it to be a really strong year with the same sort of broad set of sectors that we've spoken about in the report. I think it'll be consumer internet. I think it'll be banking, financial services, and insurance, which in different flavors of all of that, particularly banks and NBFCs. There will be some level of sort of consumer and retail, which saw some investments, a couple of large retail investments in the last year. There'll be healthcare that's probably been underinvested a little bit, including health tech as well. So broad-based sort of continued growth in the pace of investments and an expanding set of sectors is what we expect in this year.
I find it interesting that you've mentioned consumer sector, because currently, if we go by the fourth quarter earnings report, we find that the sentiment as far as consumers are concerned is pretty low. And overall, we even see chatter of a slowdown. How do you read into this? Is it structural, or do you feel it's more transient given the election background? How do you read and understand this basis the interaction you have with clients and investors?
So I think, from an overall PE perspective, there are different sectors that go through different cycles. So in any 1 year, so if you take 2018, for example, and compare it to 2017, the sector mix doesn't change, doesn't stay the same. It sort of differs by year. And that's fundamentally driven by different sectors going through cycles. If you take consumer internet as an example, consumer internet saw a huge amount of investment in 2015. It slowed down in 2016 as, capital was sort of abundant, but I think people were picky in terms of, investing in 2016. And then 2017 and 2018 have been steady. I think 2017 saw $9 billion of investment, and then 2018 saw $7 billion of investment, right? So it's sort of, it goes through cycles. Different sectors go through those cycles. Likewise, I think from a consumer perspective, we did see the Q4 issue, etc. And consumer sector, by and large, in the last sort of couple of years or so, have had very high valuations and in effect, and so that's not led to a significant number of deals. Consumer sector as a whole, in any case, from the PE perspective, is about 10% of investment. So we don't expect that to be a massive drag on future growth in sort of aggregate investments across sectors. We expect that not to last in the long term. We expect that to pick up, let's say, in about a year or so.
What about valuations? Investors have always complained that valuations tend to be on the higher side. Is there a correction given the volatility we are seeing in stock markets? Also, the perceived slowdown when it comes to the overall engines of the economy. Are we seeing a correction there with more realism coming in, or are we still talking about high valuations and more froth when it comes to that?
I think valuations will likely be fairly punchy. I'm not sure I would describe it as froth. I think what I would say is that valuations are driven by a couple of things. I think it's driven by supply or the number of participating funds. And as we talk about in the report, the number of active funds is just going up steadily. I think year on year it's going up by about 10 to 15. And, as we talk to our clients, we sort of find that most deals are now much more competitive than they were 5 years ago. The number of participating funds can be anywhere from, let's say, 6 to 10 versus fewer funds, right? So number of participating funds in processes that are well understood by all funds will only mean that valuations will go up.
Okay.
Secondly, I think from a growth perspective, we don't see, across these sectors, right, we don't necessarily see a growth slowdown. I think growth and earnings growth in effect drive valuation expectations, right? Structurally, most of the sectors that I spoke about, consumer internet is seeing really rapid growth. Banking continues to be fairly strong, etc., right? And so we don't necessarily expect valuations to correct. I won't describe it as froth. It's just, slightly higher valuations than most people are sort of, happy paying. And so that's our view.
Okay. And when it comes to fundraising, we did see many Asia Pacific focused funds have a hard time raising funds. As far as India focused funds are concerned, they already have a little over $11 billion dry powder, which is ready for investment. How do you see fundraising in the current context, given the fact that we are seeing a lot of volatility? There are macro concerns, add to that uncertainty when it comes to geopolitics, trade wars. How will all this translate for the fundraising environment?
So I think fundraising, since you used Asia as a frame of reference, I think fundraising in Asia Pacific has sort of two parts. I think China is a different story. I think primarily driven by regulation changes in the last couple of years and concerns around trade war, etc. So I think the total quantum of capital that is raised, etc., the share of Asia has come down substantially, but that's primarily, almost entirely a China issue. I don't think there's as much of an issue from an India perspective. I think the success of fundraise is always informed by the performance of your previous fund. So if you take any of the investors, whether it's global or domestic investors, etc., that are raising their next fund, etc., the ones that are more successful are the ones that have had, let's say, a stellar set of investments and have made exits that have led to returns, etc. They're the ones that are able to raise funds much more quickly with a better quality of LPs versus some others that struggle. And so I think the fundraising environment continues to be strong. As you saw, the quantum of dry powder is also indicative of the fact that there is a certain measure of confidence, and the difference really depends on individual fund by fund performance.
But the report does say that fundraising in 2019 seems to be more challenging versus last year. Are you saying India is an exception to the rule?
No, I think fundraising, I think the question of fundraising is, there are some funds, I think when you sort of survey a broad base of, when you survey a broad base of GPs, etc., when they think about fundraising, some will find it a little bit harder than others who've had a track record, let's say, of 8 to 10 years of investment in India, right? So there is some expectation that it'll be a little bit harder than it was before, but we don't really think that, there's a structural issue from a fundraising perspective.
Also, I think it's exits really when it comes to private equity. That's a true measure of how good an investment is.
Yeah.
In terms of return multiples, how do you see 2019 play out? 2018 was a strong year when it comes to exit momentum for many private equity funds. Will we see that momentum continue into 2019? I ask this in backdrop of the volatility we are seeing in stock markets, and listing, of course, is one of the main exit routes that could be explored. Do you think this will have an impact when it comes to successful exits and return multiples in 2019?
I think there are two questions there. I think there's successful exits and then the return multiples, right? So when it comes to successful exits and the public markets, I think it's important to keep in mind that volatility in the public markets, or the current state of the public markets, will impact, let's say, the 30 or the 40% of exits that go through public markets. And so if they continue to be volatile, and we'll have to see what happens after the election, etc., some of those public market exits may be pushed out a little bit, right? In terms of returns, we track it in terms of multiple of invested capital, or MOIC. So on average, we've seen, and this is multi-year, not just in 2018, we've seen MOICs in the range of 3.5 across sectors over a 5-year hold period. Some sectors like consumer internet in particular, or IT services, have returned much higher, in the range of 4 to 6 from an invested capital perspective. We think that different sectors have sort of different return profiles, so we don't necessarily think it's a year-by-year dynamic. It's not like as if, let's say, you have a strong MOIC in 2018 and then that drops off in 2019. I think the two factors that matter, you're right, I think the first one is markets and where markets are, etc. That informs the exit time frame. I mean, whether it's whether it's brought forward, whether it's pushed back, etc. And then the different sectors and the hold periods, etc. That's the other thing that informs exit multiples. But as you said, 2018 was a good year, even without the $16 billion of Flipkart exit. It was actually an excellent year from an exit perspective. That Exit took it to $32 billion in terms of exit value, as we've sort of covered in the report. Even without that, it was one of the best years from an exit perspective, because there was a whole range of exits. There were, a couple of retail exits, there were a couple of IT exits, like Intelenet, for example, and Global Logic by Apex, etc. So it was just a broad-based, set of exits last year. And again, I think the only sort of factor that we need to consider is markets. But other than that, secondary exits, etc., will continue to be fairly strong this year as well.
So basically, investors continue to have a strong appetite when it comes to markets. The sentiment for Indian markets continues to be robust. Should that be a takeaway?
I think so. I think the overall sentiment from an investment perspective, expectation of investments, expectation of capital deployment across sectors continues to be fairly strong. There are one or two concerns, of course. I mean, you touched on one, which is valuations. The second sort of caution that people tend to have when they make investments is thinking about management teams, and making sure that they're aligned with management teams in terms of trajectory of the investment. As you may have noticed in the report, the proportion of buyouts or controlled transactions has increased significantly. It's now at about 40% compared to where it was a year ago or so. In those situations, it's very important to sort of be aligned with management to some extent, and even in sort of minority transactions, etc. That's another thing that investors are typically cautious about, trying to make sure that pre-deal they're actually completely aligned in terms of vision, in terms of investments required, in terms of direction the firm is headed. But those are a couple of things that investors think about, but I don't think there's any sense of sort of shying away from the market. As I said, the number of funds is increasing. Quantum of investments continues to be strong, both last year as well as in the Q1 of this year, and so we expect that to continue.
So you basically are very optimistic and very confident when it comes to how this entire investment thesis will pan out, and that does put to rest some concerns that we've had on the macro front or closer home about how this entire election story will pan out. Do you think that investors can put these worries behind them and hope for a very strong bull run in the coming months?
I think that depends, actually, because I think you should keep in mind that investments are, of course, influenced by the government and the impact on the markets, etc., and also influenced by any global macro issues. I mean, people talk about sort of a global slowdown, etc. If that has, let's say, some level of impact on India, and that impacts, let's say, growth, effectively investors will look at a slightly longer period to make the returns that they're looking at. I mean, instead of an average hold period of 5 years that we see, that may stretch out to 6 to 7 years. The takeaway that our takeaway is that the possibility of a global slowdown, or the possibility of, let's say, volatile markets post elections, which we're not sure which way it'll go, etc., is not leading to anyone shying away from making investments. I think people will continue to make the investments because they believe that the fundamentals are strong. Fundamentals in terms of expected growth trajectory over the long term, 5 to 10 years, consumption story, number of consumers coming online, middle class shopping, product shopping, service shopping, etc. Those fundamentals continue to be super strong, and so people are not shying away from investments. I mean, we've never picked up any sentiment of investors saying, look, I want to stay away for a year and a half to see how, let's say, global economic cues play out or how the Indian election plays out, right? Deals are getting done. Record number of deals got done in Q1 just before the election, right? So I don't think it has an impact on quantum of investments, but it is something that people keep in mind in terms of returns, and it could have an impact on hold periods.
Thank you so much for sharing these key highlights with us. Very grateful for your time. Much appreciated. Thank you.
Thank you.